Lithium Americas Corp trades right now at exactly $3.01 during today's live session, climbing upward by 2.21% as trading volume accelerates. The typical retail investor looks at this absolute number and sees a struggling penny stock trapped under a mountain of clay in the Nevada desert. They see a company that does not even generate revenue yet, caught in a massive multi-year decline in raw commodity pricing. The broad consensus is that this asset is a speculative lottery ticket that will continue to drift sideways until electric vehicle adoption goes mainstream again. That common belief is exactly where the disconnect lies, because the ground reality is shifting beneath our feet in a way that regular public boards are completely missing. While ordinary traders are panicking over daily price fluctuations and temporary oversupply issues, the underlying mechanism of institutional backing has undergone a fundamental restructuring that alters the long-term risk profile of this entire enterprise. If you bring up Lithium Americas Corp on standard investing sites or pull up your individual brokerage account, the immediate glance shows a textbook pre-revenue mining company. People assume this is just another high-risk junior miner trying to get something out of the dirt. The hidden reality is that this specific asset has quietly evolved into a highly strategic, state-backed infrastructure project masquerading as a public equity. A few months ago, the United States Department of Energy took a direct 5% equity stake in the company alongside an additional 5% direct stake in the physical Thacker Pass asset itself. This came right as they restructured a massive $2.26 billion government loan facility designed to fully bankroll the construction of the Nevada processing plants. When you think about self-investing or building out a portfolio via self-investing strategies on a traditional individual brokerage, you're usually taking on absolute product risk. Here, the federal government has effectively stepped in as a structural backstop because securing domestic critical minerals has become a matter of national supply chain security. The broad public looks at the spot price of lithium carbonate and assumes the project is dead on arrival, but Washington is looking a decade out, building an unassailable domestic fortress to compete with overseas supply monopolies. Let me know in the comments exactly how many shares of Lithium Americas Corp you currently hold in your account, or if you are entirely avoiding the raw materials sector right now. When you track the massive daily swings in trading volumes on major platforms like the Interactive Brokers platform, the friction between short-term spot market pricing and long-term capital expenditure becomes glaringly obvious. The trading platform activity shows heavy short seller interest whenever the underlying spot commodity drops another percentage point. The institutional activity tells a completely separate story, though. General Motors did not back away when the commodity softened. Instead, they doubled down, expanding their total joint venture commitment to a staggering $945 million to guarantee full access to the initial phases of production. So you have this massive tension where the retail crowd utilizing standard Robinhood stock trading features is dumping the shares based on the morning headline, while corporate giants and federal agencies are moving massive blocks of capital to secure the asset. The daily volume spikes we see on the Fidelity trading platform are increasingly driven by large institutional clearinghouses accumulating at these deeply depressed valuations, where the stock trades at a meaningful discount to its actual book value. To truly understand why the stock is behaving this way, we have to look closely at the underlying business structure. Lithium Americas Corp was created as a focused, standalone entity back in late 2023 when the original parent firm split its South American brine operations away into a separate publicly traded corporation. This left the current company with one primary, massive crown jewel, the Thacker Pass project located within the McDermott caldera in northern Nevada. This single site is recognized as the largest known measured and indicated lithium resource in the entire United States. The corporate strategy centers entirely on onshoring an industrial-scale processing ecosystem, moving raw clay through a proprietary continuous production flow sheet at their technical facility in Reno to yield battery-grade lithium carbonate. Historically, projects like this are prone to massive dilution, which is why the legacy performance metrics show significant net income losses as hundreds of millions are spent on earth-moving equipment, engineering contracts, and structural steel before a single ounce of product is sold. This brings us directly to the future outlook and the critical target dates that will dictate whether expectations will finally align with reality. The company is currently driving hard toward full mechanical completion of its first phase processing plant by late 2027, with early commercial production ramping up along the way. The absolute biggest risk facing investors using the SoFi trading platform or Interactive Brokers trading tools to hold this asset is the timeline risk. Mining projects are notorious for unexpected engineering bottlenecks, environmental compliance delays, and labor shortages that can bleed cash faster than anticipated. If the company experiences a multi-quarter delay in achieving battery-grade output, the market will punish the stock mercilessly, regardless of government backing. On the flip side, the opportunity here is astronomical if they hit their markers. Because their operational costs are modeled to remain highly competitive even during a prolonged market downturn, any sudden rebound in battery demand will cause a massive structural repricing of the stock. When you evaluate this through the lens of individual wealth management, you begin to see that the common narrative surrounding this asset is completely detached from its structural engineering. The public expects a fragile junior mining equity that could go belly up if the electric vehicle market faces a slow year. The reality is a corporate entity fortified by nearly $1 billion of automotive giant capital and secured by a multi-billion-dollar federal loan structure designed to guarantee domestic mineral independence. The raw asset value sitting in that Nevada clay is enormous, and the institutional foundations are being poured deeper into the earth every single day. Ultimately, the investors who succeed are those who look past the chaotic daily charts on their mobile tracking applications and understand the massive macroeconomic architecture being assembled behind the scenes. Expectations are focused entirely on the temporary weakness of the present commodity market. The reality is an industrial powerhouse quietly preparing to anchor the domestic supply chain for the next several decades.